I'm sure you like what Mike had to say about the return of value overall. Bill, is this market cheap?
I'm not going to say that the overall market is cheap, if we define the market as, say, the S&P 500. But the spread of PE multiples today is about 40% wider than it normally is. So there are lots of expensive stocks and lots of very cheap stocks. And at Oakmark, we're always looking for undervalued names that are out of favor. Those tend to be the low PE multiple names, and those are the ones that are hurt the least by highest interest rates. So I think the value trade has got a lot of room left.
Okay, so let's start going through your list of stocks here. You have Capital One on there, which I pick out because financials are doing a little bit better. It was one of the groups that Mike highlighted. But again, the risk of recession, a change in the credit cycle and what that's going to mean for credit losses, is that reflected already in the stock?
Well, the consumer lenders have performed really well in terms of credit losses for the past couple of years. The COVID stimulus was helpful, and employment has been really strong, especially in the unskilled labor end of the market, where they've been getting real increases in wages. And that's what Capital One's market is. The stock sells at about 6 times earnings. In both the past couple of years, it's bought back 10% of its shares outstanding. Has a yield that's close to 3%. And we think they are one of the most efficient, technologically advanced lenders out there. So it's a name we like a lot.
Yeah, despite higher, credit costs and funding pressure potentially ahead. Bill, media is another area I want to get to with you. Charter Communications, also on the new buy list?
Yeah, Charter is one of the largest cable operators, and importantly today, that means internet providers. Everybody gets worried about video cord cutting, but the profitability really comes from providing internet service. Charter sells at less than 10 times free cash flow. They too have bought back 10% of their stock in each of the past 2 years. I think it's interesting to look at the comparison between Charter and electric utilities. I think Charter is a much better business, but electric utilities sell at about a 70% premium on a PE multiple basis. I think eventually people will look at Charter as an infrastructure play and justify a PE multiple twice where it's selling today.
I guess the problem with Charter and the knock against this one is just competition, right? You mentioned cord cutting, cord nevers, the competition with the streamers, the over-the-top players, and also with some of the cable providers like Dish and DirecTV.
Well, if you focus on video, there's a ton of competition, but video is not where the profits are at Charter. Charter, as well as Comcast, provide excellent internet access. It's by far the industry-leading product, gives fastest speeds to consumers at the best prices, and there really isn't much competition for them. And the more people stream, the faster the internet service they need.